The Australian Financial Review.
Ahead of the RBA board meeting last Tuesday, the Treasurer, mortgage holders and almost every trader and economist thought a rate cut was a sure thing.
With breaking news, in a matter of moments, the Reserve Bank will deliver its July interest rates decision. The board expected to hand down its first back-to-back rate cut in more than 5 years.
But it didn't go to plan.
Still the case, but this interest
On hold,
rate...
Chris, on hold.
That is a big surprise.
On hold.
OK, Michelle Bullock has decided to hold fire. Now
And what made the meeting more intriguing was that for the first time, the board revealed details of the vote. The decision was split.
For the first time in history, the Reserve Bank disclosed the number of votes that they had each way for their action, and we found out that out of the 9 members, 3 actually wanted the Reserve Bank to cut interest rates.
But perhaps this focus on interest rates is missing the point, and there's a much bigger obstacle to our future health and happiness.
Productivity does lift real incomes and living standards, but it's stagnated really. It's stuck at 2016 levels, and it's really denying Australians at the moment future material increases in living standards.
Welcome to The Fin. I'm Lisa Murray. This week, economics editor John Keogh and senior reporter Jonathan Shapiro on the RBA's shock decision on interest rates, what it means for the economy, and whether the next generation could be the first to be worse off than their parents. It's Thursday, July 17. Johnny Shapiro, welcome to the podcast.
Hi, Lisa. Thanks for having us.
John Keogh, welcome to you too.
Great to be with you.
Johnny, 32 of 36 economists predicted the Reserve Bank would cut interest rates last week. It was generally considered a foregone conclusion. It had been priced into the markets. I'm sure that Jim Chalmers had his talking points ready. But then the board kept rates on hold. What happened?
Well, Lisa, we were pretty confident that it would be a cut. We had our stories pre-written. We were just sitting there waiting for confirmation. But to our shock, the number that came out was not 3.6, it was 3.85, which meant they'd hold.
The Reserve Bank has surprised the markets and most economists by keeping interest rates
for millions of mortgage holders today as the RBA made the shock decision.
Which meant we had to very quickly
change
our stories. And confession here is we thought about having a plan B, but such was our level of confidence that we did not. So, I mean, what was quite dramatic about it is the market pricing was so confident that the Reserve Bank would cut. There was about 95% chance implied by the market. We also had the majority of economists that we surveyed, I think only 4 out of 36, did not believe that the RBA would move. But the RBA decided that they wouldn't cut rates. And for the first time in history, the Reserve Bank disclosed the number of votes that they had each way for their action. And we found out that out of the 9 members, 3 actually wanted the Reserve Bank to cut interest rates. So that was another unprecedented and historical moment. And then when we all got to Moreton Place, we had to scramble there quickly. We lost a bit of time having to rewrite our story. So that 20-minute trip on the metro from North Sydney to Moreton Place had to be done in 10. And we scrambled up the stairs, up the escalator, got to the room where they hold the press conference. And there was a real buzz in the room. There's quite a crew that goes there all the time, so we know each other quite well. And we got in a little bit of a huddle and tried to work out the best questions to ask, ready to just try team up and get the most efficient response out of Michelle Bullock, because we all had genuine questions and we were all genuinely surprised by what had happened.
Because I think you wrote in a column this week, Johnny, that there are only 4 times in recent history that the RBA board defied the market to this extent. So holding the cash rate steady when the implied odds of a cut were more than 75%.
Yes, so the numbers were crunched by Westpac back in February, and that was when the market was also pretty sure that the Reserve Bank would cut rates. And they just wanted to go back to history and see if the market had ever got it wrong. And they found that there were only 4 times in about 65 odd meetings where the market was 75% or more certain that the Reserve Bank would cut, and then they surprised and held rates. So that was one of those moments, to our surprise.
So you've all piled into the press conference. You've had this shock decision. John, what did Governor Michelle Bullock have to say? What explanation did she give for holding rates?
Yeah, well, Michelle Bullock played a pretty straight bat, and I think with the benefit of hindsight, there was a rationale for holding interest rates steady.
Okay, thank you for coming.
The several key reasons were basically the RBA's preferred measure of underlying inflation, which is what they track most closely,
Has only been in our 2 to 3% target range for one quarter, at 2.9% in March.
So it's at the upper end of that band. They don't have a lot of faith in the monthly inflation numbers, which are a bit more rubbery.
A lot of the focus was on the monthly data, and we think that's a little too volatile and not quite representative of what's really going on with inflation. So we're a little cautious about that.
Because they measure a smaller amount of goods and services each month. They bounce around a bit more volatile.
By our next meeting in 5 weeks, we will have the June quarter CPI.
So they don't want to rely on the April and May single monthly inflation numbers. They want to get the full June quarter inflation number on July 30th. That'll come before the August meeting.
So the board decided to wait a few weeks to confirm that we're still on track to meet our inflation and employment objectives.
And there was a couple of things even in the recent data around home building costs and durable good prices that maybe a little bit higher than the RBA thought, and they sort of looked at that a bit differently to the financial markets and the market economists to say, we just want a little bit more time to see that we're confident enough that inflation is tracking down towards that 2.5% target. And the other thing is also,
Reasonable people can differ in their interpretations of data.
some people are paying a lot of attention to the headline figure being only 2.1% inflation, which sounds very low, but
we don't think inflation in a sustainable way is that low. We think it's higher.
it's artificially depressed by government subsidies, particularly energy bills. And Michelle Bullock basically said, we don't believe that number. It's not really that low, because basically when these subsidies expire, those prices go back up again. So Bullock had some reasonable explanations why they didn't immediately cut interest rates, but she did signal that rates are most likely heading lower over the coming months.
And Johnny, I think the reason people were so surprised by this decision was that last board meeting, they actually considered a bigger rate cut, or what they call a jumbo rate cut, because it's 0.5 percentage point. And yet this time they decided not to cut rates at all.
Yes, well, at the last meeting when Michelle Bullock revealed that they'd considered a 50 basis point rate cut, there was a feeling among some RBA watchers that it was a dovish signal, as in she was trying to communicate that they do need rates to go materially lower, and they considered going a little quicker by doing a double rate cut. But at this meeting, she played it down.
Governor Jonathan Shapiro from the Financial Review, how do you explain how you've swung from the prospect of a jumbo cut to no cut?
She said it was more circumstances around the chaos in markets back in April and tariffs.
I'm a little surprised that got so much reaction, because I thought I said fairly clearly at the press conference that we discussed it briefly in the context of we had basically the United States and China declaring they weren't going to trade with one another anymore.
That the economy might have needed like a double dose of help, and that now the circumstances had changed, the markets had calmed down.
It was considered, but we dismissed it fairly quickly and went back to the 25, and it was the 25. So people, I think, got quite excited about the fact we considered it.
I think the 50 basis point signal at the last meeting of the consideration, that did give a lot of experienced RBA watchers confidence to think that they're going to cut rates again. It was probably a key reason I thought they were going to cut rates, because at the last meeting, she sort of said it was a plausible consideration. She implied that. So there was a bit of inconsistency in her messaging, frankly.
So let's get back to the revelation that this was a split decision. 6 members of the RBA board voted in favour, 3 against. That's the first time we've ever had that information. The disclosure follows the recommendation of an independent review of the RBA board to make it more transparent and accountable. John, is this going to create a whole new guessing game now around RBA board decisions?
Well, we only know that 6 people voted to hold rates steady and 3 voted against the decision, and later Bullock clarified that they actually voted to cut rates. I think it's a healthy thing that we know about this, because it might give us a bit of a sense how close the board was to cutting interest rates for future meetings.
And who do you think were the dissenters?
Oh, look, an educated guess, and this is not based on what I've been told happened in the room on the day, but having covered this around for a long time and have spoken to lots of officials, current and former, over a long period of time, you do build up a bit of a knowledge roughly where people sit on the hawkish, dovish stance at the bank. The hawkish people tend to put a little more emphasis on making sure inflation's under control, and the dovish people tend to put a little more emphasis on making sure employment remains strong, the economy's going okay. That's how you broadly define it. And these things can change over time as well. For what it's worth, a very educated guess from lots of conversations over long periods of time would have me think that the Treasury Secretary, Jenny Wilkinson, probably voted for a cut, not because she's there doing the bidding of Jim Chalmers, but Treasury is a little more angsty about what's going on in the global economy around Donald Trump's tariffs and Chinese economy. They also think that the full employment rate can be a bit lower than what the RBA thinks. Jim Chalmers made it pretty clear that he doesn't try and influence or lean on the Treasury Secretary to vote in a particular way. In fact, he said he doesn't talk about it.
I don't speak with her about her vote before or after.
So you didn't even ask her? You didn't say, were you one of the three?
No, I didn't.
He's made it clear that the Treasury Secretary is there as the independent Treasury Secretary representing Treasury's view.
The Treasury Secretary is on the Reserve Bank board as a representative of the Treasury, not the Treasurer.
Another person who's very likely voted for a cut because he's less worried about a wage price spiral, wage inflation, is Ian Ross. He's a former Fair Work Commissioner. He's a little bit more union aligned. So I think very likely he voted for a cut. I think the third person who voted for a cut is much more of a mystery. I think you could throw a blanket over two or three of them, and I don't think that's as clear-cut. It'd be very, very unlikely that Michelle Bullock or her Deputy Governor, Andrew Houser, voted for a rate cut. I think they would have coordinated before the meeting and probably been on the same page. And I think if they wanted to cut rates, they would have got enough members of the board over the line to cut rates. So I don't think it was them.
And Johnny, this whole new regime is very different from the past when information about upcoming rates decisions would trickle down into the market. How do you think it's going to work?
Well, it's anyone's guess, actually. What was really fascinating, and maybe historic is a strong word, but I'll go with historic given the reaction of many economists in trying to make sense of the decision, is this was a clean break from an old regime of how the Reserve Bank communicates. So it's almost a dark art. There's no sort of formal process about how the Reserve Bank communicates to the public, but what a lot of economists and traders had grown to accept as reality is that if the market pricing was out of whack with the Reserve Bank's thinking, they would use some ways and means to bring those two together.
To steer the market onto the right course.
Yeah, and one famous economist who sort of made a career out of making these loud and proud RBA calls, Rory Robertson, he was telling me a story how in early 1990 there was a feeling that the Reserve Bank might have to hold an emergency meeting because the economy was so weak to cut rates. So the wise old economists at the desk sent out their juniors to the car park of Martin Place with a brief to keep an eye out for any board members driving into the parking lot.
That sounds like good old shoe leather journalism.
Absolutely. And he said it worked. He said they spotted these board members entering Martin Place, and lo and behold, there was an emergency meeting where they cut rates. So they would somehow get their message out, whether it's ringing up an economics reporter or making a speech or using a Q&A at a conference. They would send signals to the market. That was the belief. Again, nothing was ever formalized. But when Michelle Bullock was asked about this, her body language sort of acknowledged that this was in fact the way things used to work, but this is not the way things will be able to work at the moment because there is an independent board that meets at every decision, and she does not want to prejudice the board or preempt a decision.
I can't go out and suggest to the market that the decision might be X if the decision hasn't been made.
Now, the issue with that is the board has always been independent, so nothing's really changed. And that didn't seem to stop the Reserve Bank getting their message through. But Michelle Bullock is at least trying to project that things are going to be more transparent from now on. Board meetings are genuine discussions about decisions. Nothing has been predetermined. Maybe in the past the governor was really dominant and, could have confidence that the view of the governor would carry the day, but not anymore, is her message.
But Johnny, maybe we're actually focused on the wrong thing. I mean, with these obsessions of interest rate moves every 5 or 6 weeks, rates movements can give the economy a bit of a sugar hit from time to time, but they're never assured. And on the same day, Bullock was actually announcing at 2:30 p.m. via a statement that rates had been kept on hold. I was actually at a speech being delivered by the Productivity Commission chairwoman, Danielle Wood, a few blocks away in Sydney, and she basically said, and Michelle Bullock's also basically admitted this as well, that it's not so much interest rates that are the key to our future financial success, but it's actually productivity growth. That's the key to our wealth, our health, and even our happiness, according to Danielle Wood.
John, we're talking about the Reserve Bank's shock decision last week to keep rates on hold. Most economists had expected another cut, and the market was forced to adjust when that didn't come to be. But Bullock wasn't the only person in the spotlight last Tuesday. As you just said, the head of the Productivity Commission, Danielle Wood, also gave an important speech on the economy. What did she have to say?
Well, Lisa, this is all in the context of this productivity roundtable Jim Chalmers, the Treasurer, is going to hold in Canberra over 3 days in August with business unions and policymakers. And look, she said a lot of things, but here's the sort of quick take out of Danielle Wood's speech. One of the problems she identified is that the economy has been swamped by a lot of well-intended regulation that slowed business investment in things like equipment and workers, and that has contributed to some of the slowdown in productivity and real incomes over the last 15 years, particularly in areas like housing, infrastructure, energy rollout, those sorts of areas. And she did talk up the benefits of growth for productivity and the economy more generally, and pointing out that the average Australian today has incomes about 3 times higher, lives about 11 years longer, and has about 5 hours a week more additional leisure time compared to the average Australian in 1960, largely due to better and faster ways of doing things. And productivity does lift real incomes and living standards, but it's stagnated, really. It's stuck at 2016 levels, and it's really denying Australians at the moment future material increases in living standards. And just on the business sort of regulation side of things, she did throw up some pretty interesting examples. She talked about a development application to build a 3-storey block of flats in Sydney in 1967. It was about 12 pages long. Now she says it runs to hundreds or thousands of pages. A Brisbane cafe has to fill out 31 forms before it can even open up. She said clean energy projects had to wait more than 500 days for Commonwealth environmental approvals, and wind farms even had to face approval delays of 9 years. So this is all putting sand in the wheels of getting things moving in this country.
And John, it's hoped the Productivity Roundtable that you mentioned that's being held next month will have an impact, because there's a lot of concern and anxiety among younger people that they might be the first generation not to be richer than their parents. You wrote about some research last week that covered this issue. What did it show?
This is a really interesting analysis by some younger economists at the E61 Institute, who I dare say are probably in that, around about that Gen Z kind of mark, people born between 1997 and 2012. And I think there's something in this for the optimists and the pessimists. There is a lot of pessimism at the moment about this so-called intergenerational tragedy that Ken Henry's spoken about, that younger people might be not as well off or worse off than their parents. And that's not really ever happened, because fundamentally through the generations, living standards get better. We end up richer and better off than our parents. But E61's analysis found that, yes, Gen Zs will ultimately, in the long term, be better off than their parents, but it is going to take them much, much longer to get to that position. That'll come up later in life via not just wages, but things like inheritances and housing wealth. So they also suggested that tax and other policies like superannuation and student debt are actually working in the wrong direction for younger people. They're taking a lot of money out of their pockets at the very time in life when they might be struggling to afford to buy a home, a car, educate themselves, pay for children, travel. But in the long run, they're going to end up richer and they're not paying as much tax or not having as much money taken out of their pockets when they could probably afford to. So there's a lot of considerations about what this means for tax policy, what it means for superannuation, what it also means for student debt, and also just it's why productivity is so fundamentally important, because when we get higher productivity growth, it'll lift all boats and younger people and all people across all generations will be better off.
So while it's important to look at productivity reform and tax reform to try and lift living standards and address the problems that have come up with the intergenerational divide, on the immediate economic front, there's a lot that's out of the government's hands. John, Trump's tariff threats and his overall unpredictability are making it pretty hard for our economic policy makers right now. How do you think that uncertainty is affecting the economy and the ability to make policy and set interest rates?
It's not helpful, but I don't think we should exaggerate the direct impact of Donald Trump's trade tariffs on Australia. I think most of the research from Treasury, the RBA, independent economists like Warwick McKinnon have suggested it's a pretty limited, small impact on Australia at this stage. Where we need to be a bit concerned is if businesses around the world pull back on spending on capital investment just because of the sheer uncertainty, because we need business investing because that's what make workers more productive because they use new tools, equipment, technologies, those sorts of things. But I don't think our policymakers, frankly, should be using it as an excuse. If anything, it accelerates the need to get on with the job and control what we can control. And, it comes back to those sort of areas of tax regulation, competition policy, innovation, education, to material lift our own well-being, despite what the world's sort of throwing at us.
But there's obviously concern around the RBA board table because Bullock said that when she was asked why the dissenters didn't vote for the move last week, she said downside risks on the international side was something they were concerned about.
Well, it's something they're keeping a close eye on. But I think the worst case scenario has passed. And if things turn bad on the tariff front, like there's a trade war, a proper one between the US and China, well, the RBA has capacity to cut rates aggressively, and she sort of intimated that.
Yeah, and Lisa, I guess one of the other things we're watching with interest in the United States is Donald Trump has, at every opportunity, he decides to have a swing at Jerome Powell, the Fed chair, for not cutting rates. Now, I mean, it's fascinating to compare what's happening in the US with here. So I guess we had a very, very tame version of that. We had Chalmers being very passive-aggressively miffed that the RBA held rates, but that's not how Americans do things. It's all chest beating, and Powell really is being threatened. I mean, the central bank's independence is to some degree being threatened by Donald Trump, who's made overtures that he's going to replace Powell with someone who will cut rates. And there is a broader global trend where elected officials feel like they have more of a right or more of a duty or obligation or desire to bend the will of the Reserve Bank or the central bank in their favour.
So, Johnny, how is all of this affecting markets? They got it completely wrong last week. They're being buffeted by Trump's missives every day. But the reaction has actually been quite subdued. Are markets becoming immune to these external shocks?
Well, it depends how we define shocks. So I think the Reserve Bank's decision was a shock to anyone that was trading short-term interest rates, whether you're a hedge fund or a bank or a fund manager, and you've taken these very, very big bets on a decision, you probably would have been very hurt. Economists' pride would have been very hurt. But Bullock very quickly made it clear that the direction was still down, and the broader markets generally took it in their stride. The Australian dollar jumped, as you would expect when interest rates are held, but it didn't really even jump to above where it was the day before. I mean, I guess if there's a broader concern if you're a mortgage holder, it's that, the Reserve Bank is slightly reluctant to cut interest rates at this stage. They need more evidence. They'll probably get there, but, you would have hoped if you have a big mortgage that they would have gone in July because, there's always a risk that they don't go in August. So maybe there was a dent in confidence, but the takeaway of last week was that the way the central bank does things has materially changed, going to be a lot more unpredictable, and we should just expect, the path of interest rates to be a lot choppier and more interesting.
So a final question for both of you. What do you think is going to happen with interest rates when the RBA board meets next month? And will there be any economists brave enough to make a call?
Lisa, I think it depends what happens with the quarterly inflation data, and we're going to get into labour employment report as well. But look, the most likely scenario is that they cut interest rates on August 12th, but I don't think it's a done deal. Let's actually wait and see on the inflation figures that the RBA is waiting for. I think we should all take a lesson from this recent meeting that there's no such thing as a sure thing.
Well, I think what will be interesting is if that inflation number is awkward. If it comes at a level where they probably want to cut, but they might feel like they shouldn't because they didn't before. So it could land in a very awkward and interesting place, and I'm very fascinated either way to see how Michelle Bullock spins a decision, whichever way it goes. I think the other enduring point is we won't get these, as John said, there'll be even less certainty around bets. I think John would agree, though, a lot of economists probably thought the RBA should hold. That was their belief, but they didn't factor that into their call. They were guided by the market and guided by what they thought they should think about Michelle Bullock. So I think from now on you'll have economists with a lot more conviction, a lot more division, and that will just make everything way more interesting than it has been in the past.
Thanks, John. Thanks, Johnny.
Good to be with you.
Thanks, Lisa.
Thank you for listening to The Fin. I'm Lisa Murray, with Financial Review economics editor John Keogh and senior reporter Jonathan Shapiro joining the podcast today. The Fin is produced by Alex Gow and Mandy Coulin. Fiona Buffini is head of premium content. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us, as it helps others find us. For more stories about markets, business and power, subscribe to the Financial Review at afr.com/subscribe. See you next week.
The Australian Financial Review.